Chase by Dallas, make it hurt.
Good day, everyone, and welcome to another episode of Let's Talk Commercial Real Estate Investing, the Black Community Edition. I am your humble host, Dominic Green, Managing Partner of Atentico Commercial Real Estate Services here in the Dallas area, DFW area, because we service all of Dallas, Fort Worth, and pretty much all the major places in Texas, depending on the client. But today I just wanted to drop in on Education Wednesdays and just expound on a brief presentation that I gave or discussion that I was allowed to give for a conference for someone that just hosting a conference about investing in alternatives outside of just your traditional multifamily, just different segments. And as you know, I've kind of talked about it here briefly on other episodes of how I've kind of looked towards the affordable and preservation of affordable housing as kind of a segment to invest in. First and foremost, it's something totally different from what everybody else is doing, which is large value adds, deep value adds, raising rents as high as possible. But given that what I've seen, because I'm in real estate, helping individuals in certain aspects of maybe residential that are family, you continue to educate and continue to read the news and just seeing stuff that's on the ground and participate, being involved with the conferences and stuff like that for affordable housing, you realize that how severe and how big of an issue it is. So kind of like I said before, the ongoing investment thesis and theme is affordability, right? We're in the affordability crisis. And so also, as I was telling them in the presentation, like just in the state of Texas, everybody talks about Austin. Austin is, their housing prices like dramatically increased 50%, over a couple of years. And that's just because of the influx of people and it becoming a tech hub in a sense, with the Apples and stuff like that, that moved there, Facebook and stuff like that. So, those particular people that they're bringing in from other states, especially, people that come from California, they have a little bit more cash on hand. And, with the already shortage of available housing, just prices just jumped. And, we're already behind on trying to meet that demand. And with that, there's an affordability demand. So people who can't buy houses, they got to have somewhere to stay. They got to rent. And even before that, we were already kind of had a shortage of just affordable housing. So like there's a site like the National Low Income Housing Coalition. They have on their report where you can go by state and just kind of see the need for housing, right? The need for affordable housing. And I know in Texas here, overall about 49% of the population is considered what's called cost burden. And how they relate that is people that are paying more than 30% of their income towards housing, right? And housing related services. So in that statistic, when they broke it down, there's a spectrum of how they categorize it in affordable housing where it's segmented. So people that are 0 to about 30% of the area median income of area, which they kind of consider the extremely low income individuals. Out of that, 80%, 89% are cost burden, but out of 89%, 74% of those individuals are severely cost burden. So, these are the individuals that are, kind of in transitional housing in a sense, homeless shelters and stuff like that. Which if you've seen the articles in when we're talking about Austin, homelessness is a big issue. I mean, this homelessness is a big issue in Dallas as well, and just about anywhere, right? Anywhere that's had a huge increase of housing prices and shortages of housing. And then, obviously the whole eviction moratorium for a lot of people is ending, or has ended, so unemployment benefits are gone. So, there's going to be probably another influx of individuals in a bad situation. But then again, in that breakdown, 81% is very low income. Those are the individuals that make 30 to 50% of the area median income. Out of that 81%, 32% were severely cost burdened. And then you go down to just low income, 47%, and only like 5% of those people were cost burdened. And then the people that were kind of like in the moderate level, they're making 80 to 100% of the area median income. I mean, it was a very small percent that was severely cost burdened, but nonetheless, they were cost burdened. So, because they have this term in when discussions we were talking about affordable housing, kind of like the missing middle, and these are the individuals that, because affordable housing in itself is income restricted, so it's based on your income. There's individuals that make too much money to be able to qualify to be in these locations, to be in these properties, but yet don't make enough money to afford to be in some of the more market rate type of properties. So oftentimes they're, I'm also looking at, which is called your NOAAs, your natural occurring affordable housing product. It's just product, B and C class product that's gotten older as time has gone on. They have some updates in it. But in those situations, when I'm looking at those properties, it's not something I'm wanting to go in and add granite countertops and all that stuff. No, we go modestly, update some of the fixtures, update some of the flooring, paint, make it look nice, make it look safe. Partner with local nonprofits, partner with local residents that are in the medical, that are teachers and stuff like that, to provide additional services on site and create a community, right? And in that, we're able to maintain affordability. Yes, we may charge a little bit more because of the improvements, but it's not something that we're trying to maximize rents. Maybe $25, $50 here. It just depends on how it pencils out. But because what you realize, and I probably said it before, the Blackstones, the KKRs, all the the private equity groups are starting to pile into affordable housing. And a lot of it has to do with, they kind of see it as a core plus type of investment, meaning very little, upgrades needed, but they cash flow. Like if you listen to the guys that own these properties, they talked about how they maintain high occupancy even during COVID, even during the '08 crisis, and even with that, you have the competition. You're having competition now. When you listen to the guys that do the brokerage of these properties on a daily basis, to where there's already compressed cap rates, just in general for market rate properties, and now you're starting to get that in the affordable part because people are, investors have realized the opportunity there, for both reasons, for both maintaining, preserving affordability, and then the other one is because a lot of those properties are at the year 15, which means they're no longer in the monitoring compliance period. So potentially they'll go in there because the rents are already under market. They'll go in there and they'll take it and upgrade the property to a different consumer base or clientele, right? So get closer to the market. But for the most part, those other guys were looking to preserve. I know the Biden administration recently announced that their plans to aim to increase affordable housing, pushing allowing Fannie and Freddie Mae to have more money to provide loans and maybe invest in the tax credits for that. So you keep seeing it. Like I said, this is one of those things where you keep seeing it in the news. People are already kind of picking up on it, and it's just about finding an opportunity to actually do it. Starting out small and then gradually getting big to make a difference. So For me, I think that's where it's a great opportunity for us from an investment standpoint, because we're thinking long term, we're thinking cash flow, because with that cash flow allows us to fund the things that are most important to us, as I always talk about. We all own and control. We'll be able to make a change, have an impact, because a lot of majority of people that look like me and you are mostly in these properties, right? So with that being said, it's an opportunity to, you know, invest, provide additional services, provide help, but also cash flow and get a return on your investment for you and the investors that join you and your partners that join you. So I think it's one of those things. Like I said, demand is going to be there for a minute. It was already a demand for it prior to COVID. I think it's been accelerated some, and will continue to be just until things either adjust. And I don't know when that is. I don't have a crystal ball, but I do know that in downturns, typically people look to cut costs. And like I was telling the one lady, like you saw people that were in your Class A properties, and some of those Class A properties they left and went to B class properties, right? Because it's more of a lifestyle for them. They have the income. But because they're downsizing, trying to save money and all that, they went down to the lower class. So I think there's always going to be an element and a need for a need to preserve the affordability. And so that presents an opportunity. Now, affordable housing in that particular segment is highly regulated, so it makes it challenging, but yet it creates an opportunity for you when you master it, because not everybody's going to want to deal with that, right? It takes a certain type of individuals, which there are people on a large scale doing billions of dollars in it. As I mentioned before, Turner Impact, Avantha, here, I want to say in Houston, and even they got property here in Dallas, Atlantic Housing. I mean, there's other institutions or institutional firms that have billions of dollars of investment capital that are in this space. Like I said before, from Stephen Ross made his money with affordable housing and became a billionaire in it, and then just kind of progressed from there. So, there's opportunity in that. But it is one of the things you definitely have to pay attention to, because, in that research, like I said, the biggest thing is you can't, especially if you're doing affordable, you can't necessarily raise the rent as much. So you have to focus on the operations. You have to focus on maintaining, the maintenance of the property, obviously, to keep people happy, the services, but also reducing your turnover, because turnover costs. If you have a lot of turnover in that property, that's going to, be detrimental to your cash flow. But people are doing development in this, and the reason being is because the way that the government incentivizes with tax credits, right? You have the 9% and the 4%. The 9% is competitive, the 4% is non-competitive. And what I mean by that is because 9% tax credits allow you to get more equity, usually about 70% of the equity, where the 4% tax credit is a lot lower in equity, maybe under 40%, or maybe under 50%. Under 50% of equity, and then the rest is used, but it's usually attached to like some type of bond program that's tax exempt and other low cost financing, to kind of bridge that gap. But usually the 4% is going to be used for mostly rehab, which for me, I'm looking at stuff that's already existing, and to go in and make substantial changes, kind of bring it to relevant standards, and then just cash flow it out, because these tax credits for 10 years, cash flow these things out. Like I said, it's kind of more of a core investment, so you got minimal appreciation. In the short term, for long term, you'll appreciate, but in the short term, you won't. But you'll be able to cash flow this thing, so it would target more of the groups or the investors that we would go after that are interested in more so cash flow, and they're preserving their wealth. They have the money. They're just looking to maintain, looking to get income every month, every quarter. They're necessarily needing to grow their money, because they're just at that stage where really thinking about retirement, if not close to it. So, or they're just a family office or something that's looking to maintain and preserve the money that they built over years. So, there's different people that this will probably target to. But like I said, prior to that, I kind of got off track. But from the developers, they're incentivized where they get their development fee. So development fee and affordable is about 15% compared to the market rate is about 3 to 5%. So that's a huge difference. And then plus, you're getting equity from other sources, from the city, from the government, and then you just got to figure out how to bridge the gap. But you also got to, go through the hurdles of the point systems and development for sites and trying to get awarded these tax credits, because on average, I want to say it's about, well, here in Texas, I can't speak for everywhere else, but it's about a 51% success rate, roughly, from the point of submitting your application to make sure you got all the points you need to in the point system, because there's points in there for if your particular development is going to be affordable for like 55 years, you know what I mean? So there's certain criteria that you have to go through and make sure you're hitting, to put your application forward and put your best foot forward with that, and hopefully you get awarded tax credits. And there's more details on that, but I can go into that if you guys decide we want to talk about that in more detail. I'm not necessarily looking at development, not initially for anything that I'm looking to acquire, because I want to continue to build that knowledge base and then, build the reserves and then jump into any type of development, because, development is definitely risky. Hence why you get the fees, you want the higher IRRs and returns and stuff, because you're taking that risk. So that's something that, from all I've heard and listened to people that I consider mentors, that's something you kind of just want to wait on in your journey. But, everybody has a different mentality, everybody has a different way of investing, everybody has different thoughts. But like I said, I think this is an opportunity, especially preserving, if you don't do affordable, at least looking at properties that you can preserve affordable housing. If you own single family, you probably notice that a lot of times you don't change out the Formica countertops and stuff like that. Nothing, you probably do the floor and you probably have some paint. And those people that's been in that property, you maintain a relative affordability, you maintain that property for a while. So kind of that same concept when we're talking about multifamily, as an investment to build wealth as well, provide cash flow. So like I said before, I say always, this platform is for us to, share, collaborate, share experiences, provide a resource, be a resource, so we can all work together for the common goal. Like I said, and it's all about ownership. We can also make an impact in communities that look like us, and other communities that allow us to be in, right? So, hope that was informational for you on this Educational Wednesday. Like, share, subscribe, leave a comment, join our Facebook group, as we're going to continue to grow this thing. I'll continue to provide information every Wednesday on what I'm seeing, what I'm reading, what I'm participating in, things that I think, because I want to talk about the whole spectrum of commercial real estate, not just one in general, because I think everybody has a different appetite for different types of product and different types of things and different types of risk. So just given the experience I know, but again, I don't know everything, but from what I do on a daily basis, allow to kind of get an insight from helping other businesses lease, because we understood that, we are the supply of we are the demand of the actual supply. So if you can understand what the people want, that's from a tenant standpoint, you can tailor your properties towards that and acquiring them to sign up a lease. So, like I said, hopefully this was informational. Hopefully we can all continue to work together. If you need to reach me, definitely reach out. My information is in here as well. Yeah, man, let's continue to work together. Let's continue to collaborate. We can do more together, for the ultimate goal to acquire ownership, wealth. With wealth comes leverage. With leverage comes, influence, and with that influence comes power, right? And that's something we all need, especially when we want to make changes in communities in ways that things that we've been treated and other things that go on in our community. So it all starts with the economic empowerment. I'm hopefully doing my part and providing, not only participating, but providing resource or information in that fight, because I think that's very important. So until next time, happy investing. Like, share, subscribe, leave a comment. Deuces.
Beats by Dallas, make it hurt.